Hello, everyone. In this video, I will walk through the Caterpillar practice problems to calculating the weighted average cost of capital. So let's get started. So basically, for weighted average cost of capital, this is the formula we're going to use. And apparently, we discussed in class, these will be the components that you have to calculate it or estimate it in using different method. And then eventually we're going to just plug back into this WACC calculations or WACC formulas to derive the weighted average cost of capital that we're going to use for the DCF model. So we'll get started with the simple one. The first one is the equity value. So in order to calculating equity value, or more specifically, the market value for a company's equity, in other words, to say this would be market capitalization. So we just need the information about shares outstanding and trading price. So this trading price really depends on when you conduct this analysis. You should use the most recent closing price. So the example for Caterpillar, basically, we're going to work on their 2019 financial statements. Therefore, I picked the 2019 December 31st stock closing price to calculating my equity value. And then for this shares outstanding, so basically for your project or assignments, make sure that you use the diluted shares outstanding. Try not to use the basic shares outstanding, okay? And also pay attention to the unit of figure that you're calculating these values. Apparently, if you go to the debt schedule, you can take a look. Everything we show up on the financial statements is denominated in millions. So meaning that when we calculating this equity value, we should also convert the actual number of shares outstanding to denominate in millions, okay? So then for equity value, this is pretty straightforward calculation. This is just equal to the trading price and multiply by the shares outstanding, you get your equity value. And then we move on to the second components for the WACC calculation will be the debt value. So for debt value, basically in class, we introduced the two concepts there. One is the total debt, the other one is net debt. And the intuition behind this decision is just we have to decide whether the company is funding their cash reserve using debt or they use the new debt to expand their business. So to calculating the debt, for Caterpillar examples here, we're just focusing on the debt items. So specifically, if you take a look at their balance sheet here, on the liability side, we have two sections related to that. One section is a long-term debt due within 1 year. So this is considered as a short-term debt. The other section is long-term debt due after 1 year. This is considered as long-term debt. Then we just have to copy the terms there. You can type there or you can copy paste there. And then for the short-term debt, we're going to just link the value from balance sheet. Same idea here. We're going to copy the term here. And then we're going to link the long-term debt value. Then we can calculating what is the total debt. So total debt, basically, you just take a sum of your short-term debt and long-term debt. You get your total debt value. And then if you believe the company is funded their cash reserve using new debt, that means like we have to focusing on the net debt. Then you have to grab the cash equivalent. So this is what this excess financial assets mean. It's basically just excess financial assets that you did not use to invest into your operations. So for our examples here, we have cash equivalent. And then we can just link the value for cash equivalent. Then we can calculating total net debt, which is using the total debt value, subtract the cash equivalent. You got your total debt. Next, we're going to move to the effective tax rate. For effective tax rate, basically, you guys took the accounting class. That's just calculating tax rate using the taxes the company is paying, which our examples here will be provision for income tax divided by profit before tax. Okay, there are different arguments. People may argue that in the 10K or 10Q filings, companies may also provide you with the effective tax rate. And especially for some special scenario, like Tesla in 2023, they receive a large amount of money related to tax credits, which is a one-time tax credit. But if you take that into your tax calculations, which may skew your WACC a little bit. Okay, so try to find a reasonable effective tax rate that you to use for your WACC calculation. For our examples here, we're gonna just let's take a shortcut here. We can basically just link the term here. Oh, we link it here, this one. So that will be the profit before tax. And then it's gonna be the provision for income tax. And then we can basically just link the value, profit before tax. And for the taxes, so here, just pay attention, because I set up my income statements in this example specifically. I set up the income statements for all the expenses as a negative value. So I put in the parentheses. So don't think this is a tax benefits here, although I know the term is called tax benefit, but basically when I input those or hard code these numbers, I intentionally just keep all the expenses as a negative value. So therefore you'll see a negative tax here, but it's not tax benefits. Therefore we have to convert it to positive. This will be our tax. It really depends on how you set up your income statements. So it's not necessarily mean that every time you have to give a negative sign. Like for this semester, for all of our in-class demonstration, I kept all the expenses as positive value. Therefore, we're going to subtract that. So when you're calculating this tax rate for our in-class example, like Amazon, you just directly grab the tax, use that divided by earning before tax, you get your tax rate. So for tax rate here, it's just equal to taxes divided by earning before tax, you get your tax rate, 22.35%. And then we move to the next component, which is the cost of debt. So here for cost of debt, at least for our class, I mentioned in class that you have to understand two methods to estimate the cost of debt. That's also related to the topics here. So it depends on, based on your evaluation or research, whether the company borrowing money through debt to fund their cash reserve or to fund their business operation. That's two different scenarios. If you find out the company borrowing the money through debt to fund their business, then when you're calculating the debt value, you should using total debt. When you're calculating cost of debt, you should just focusing on the debt and interest expense. But if you find out the company is borrowing money through debt to fund their cash reserve, then when we're calculating the debt value, we should use total net debt. When we're calculating the cost of debt, we should use the net interest pay divided by net debt. Okay, so these are the two methods that you need to understand for this class. But for the practice problems here for Caterpillar, I also introduced this couple extra method that you can assess the cost of debt. So let's get started. The first one, if we believe the company's borrowing money through debt to fund their operation, then we're focusing on the total debt. So total debt calculation, actually we already did from the debt value part, but we can do that one more time. And basically what we're going to do is we're going to just go to the balance sheet, find the short-term debt and the long-term debt. So for this one, let's just go ahead, copy those two terms here and two terms here. They call the name exactly the same, but the first two are for the short-term debt. There will be long-term debt due within 1 year. The other two are long-term debt. And then let's go ahead and link the value for both 2018 and the 19 is because when we're calculating cost of debt, we're going to divide it by the average debt, meaning that the average between previous year debt value and this year debt value. So this is going to equal to you can copy the formula, and then for the long-term debt, now we can solve the total debt value by adding these two, the short-term debt, long-term debt together. Now we derive the debt value for both years. Then we just have to find out what is the interest expense. We can type interest expense. We only need that for 2019. So go to income statements, find your interest expense. Same idea here, because for this Caterpillar examples here, I kept my cost as negative value here in the income statements. Therefore, we have to give a negative sign to convert it to positive. So for this one, you see I give a negative sign and then link to 2019 interest expense. Then when we're calculating cost of that, we're going to using the interest expense divided by average between 2 years debt value. You get your implied cost of debt. So this is the way we're using the only interest expense divided by average total debt, meaning that we believe the company issued debt or borrow money through debt to fund their operation. Okay. So another scenario here, if we believe the company is borrowing new debt to fund their cash reserve, then we have to calculating the total net debt value. And then for the interest, we have to figure out what is the net interest paid. So for the net debt value, let's just go ahead and link the value. This will be your short-term debt for 19 and 18. So we're going to link these two values for both years. And then for the long-term debt, same idea. We're going to link that from 18 to 19. And then we can take a sum of these. You get your total debt value. That's exactly what we solved here. But for this method, instead of using total debt, we do have to get another line here. Let's link the cash equivalent for both year, because we do want to calculating the net debt. Okay, I know here is only one row here. Actually, technically speaking, this row is not necessary. But if you do have a separate rows there, then you do have to calculating the total excess financial assets. So here we only gonna have one row. Let's just link here. Then what is net debt? The net debt is equal to total debt value subtract the cash equivalents. You get your total net debt. And then for interest pay, since we already get interest pay here in the income statements, that means we're gonna do the same thing, give a negative sign, and then let's link this interest expense there. But we need to calculating what is the net interest paid, meaning that we have to find the information related to interest income or interest earned. So this is not reflected on the income statements. If you take a look at these two accounts, apparently we have one account is about interest expense, but the other one is other income. So we can assume maybe something under this other income is related to interest income. So if you did the keyword search from their 10K on, this is the screenshot that I gave you. Under other income, you see that they list out the different other income they generated. But what we need here, we need the investment interest income here for 2019. So that would be 202. Then for this one, we just have to hard code it 202 here. Take a differences, use your interest pay, subtract the interest earned, you get your net interest. And then for this implied cost of debt, we're gonna using net interest pay divided by the average of net debt. Okay, why are we calculating this way again? Is because we believe the company is borrowing new debt to fund their cash reserve. So this is the second method. So you do need to understand this, both these two methods for our class. Okay. And then I did give you various ways to calculating or alternative ways to do that. So far we just using the debt value provided by the balance sheet. But technically speaking, when we calculating the cost of debt, another thinking or reasonable thinking will be like we should only focusing on the interest-bearing debt, meaning that if you search the notes from their 10K, they will give you some information specifically for the interest-bearing debt. So like the notes I give you here, they provide you with short-term borrowing, long-term borrowing from their 10K. So if you believe there are some debts that you included from the balance sheet, is not all about the interest-bearing debt, then you can use the information from here. Meaning that for the short-term borrowing, we're gonna basically just hard-coded these two numbers here. So short borrowing for 2018 gonna be 5,723. And then for the 2019 short-term borrowing, that will be a 5,166. And then for the long-term debt, we're gonna grab these values, 26,281 for 2019. 26,281, and then we're gonna grab this one, 25,000 for the long-term borrowing. Okay, 25,000. And then we can take a sum of these two rows. It will give you the total values only for the interest-bearing debt. And then how about interest to pay? So for interest pay, if you read the notes, they do tell you that in 2019, the short-term, long-term borrowing interest paid is $1,057 million. So you can type in there, there will be a 1057, and then we can calculating the cost of that again using the interest to pay divided by the average of 2 years interest bearing debt, and you get your cost of that. Okay. I cannot say which method is more accurate. It's just like it's based on your different assumptions here. So for the first one, we solely rely on the information provided by the balance sheet. And then for this one, and this is where we assume the company borrowing money through debt to fund their operation. And this one, for the implied cost of debt using the net interest paid, net debt is basically, we assume the company is building their cash reserves using the debt value. But again, all those information coming from the balance sheet. And then this one specifically, we basically believe that there are something reported on the balance sheet is not the interest-bearing debt. So we do a keyword search under specific notes. We find out that these specifically short-term borrowing, long-term debt will occur the interest expense. So we just using the debt value like this and then grab the interest to pay from the notes and calculating the cost of debt. And then in class, I also showed you there's other ways like what if we don't have the balance sheet information? So we can try to find the similar rating for the bond if you do have a credit rating for the business. So the table I give you here is like it depends on the different ratings here. We can, if the company is rated a AAA, so you can just grab that a rating related yield to maturity as the proxy for your cost of debt for that specific companies. And what if we don't have the rate? So this is the alternative method I introduced in class. So if we don't have a rate, we can calculate in the synthetic ratings. So basically based on their interest coverage ratio, we can compare that in this table, which is you can search online, you can get this one. And to find what will be the related rating for specific range that your interest coverage ratio falls in. So first we can calculate the interest coverage ratio. This is equal to, go to your income statements, and this is equal to 2019 operating profits, and then divided by interest to pay. So here we do have to convert this to positive. So give a negative sign, and then choose this one. Now we have the interest coverage ratio for Caterpillar. This is 19.69. Looking at the table here, this 19.69 falls into this range between 8.5 and the 10,000 or 100,000 specifically. That means we believe the company's the synthetic rating will be AAA. So if you give a AAA there, and then the associated risk spread will be 0.69%, meaning that this will be the actual return that you have to pay your debt holders if you want to borrow the money from your debt holders. Okay, but how are we going to use this spread to calculating cost of debt? So this is the additional risk your debt investors or lenders are exposed to by comparing to or upon this like risk-free rate. So therefore, you do need to find the risk-free rate, and whatever the extra rate here as the spread here will be the actual return that you have to pay your debt holders to be able to get their fund. So risk-free rate, we can use a 10-year treasury yield. You can use a 15 years, 30 years. It depends on your assumptions. Okay, so for 10-year treasury yield for 2019 December, I give you that in the tab. So for this one, yeah, you just have to scroll down a little bit further to find your 2019 December 31st. So your risk-free rate will be 1.92%. Then we can come back here, plug in this 1.92%. Combine these two together, you get your approximations for the cost of debt using this synthetic credit rating method. So this is equal to 0.69% and plus 1.29%. And that gives you 2.61% cost of debt using this method. So for our class, at least you need to understand the first two methods because you may see that from the exam. But I do want you to take a little bit of time to practice other methods because sometimes you may not have certain information, then you have to find the certain ways to be able to estimate the cost of debt for your WACC calculation, okay? So this will be the cost of debt. And then we're moving to the tab number 6. We're gonna starting to moving to, technically speaking, the last items in your WACC calculation. So in the WACC calculation, so far we talk about debt value, we talk about equity value. You learn various methods to calculating cost of debt. And then you also learn how to calculate effective tax rate. The only thing left will be this cost of debt. And then if the company is paying dividends, we can use the Gordon model to estimate the cost of debt. So the way the Gordon model works is if you can find the information, this one is pretty easy to find. This is your current share price. You can just search online. And you need to also find what is the dividends payment over last year. So this will be your last year dividends payment. Normally, company pay dividends every quarter, meaning that you have to combine the 4 quarters dividends to derive this yearly dividends payment. And then if you given or you find a way to estimate the growth rate for this dividend payment for future, then you can basically just start using the Gordon model functions that is equal to dividend over last year multiplied by 1 plus the growth rate and divided by shares price and plus the growth rate. This will be the way to solve cost of equity using Gordon model. So if you understand this, then pretty much, as I mentioned, these two values is easily to find online. The only thing you do need to estimate it will be the growth rate. Okay, so now let's using Caterpillar as examples to assess or try to estimate it, what is the growth rate for their dividends payment. So since company paying dividends every quarter, and for our Gordon model, we do need a yearly dividends payment. So once you gather the dividends historical data, you do have to calculating what is the historical annual dividends payment. Therefore, we're gonna starting from the bottom part here. We know that our most recent year will be 2019, and the database is all the way traced back to 2009. So let's just starting to set up the year in the first column. And to save a little bit of time, we can basically just use previous year -1, you get your year set up. Then once we get this done in class, when I demonstrated, basically what you need to do is let's using 2009 as an example because it's right up here. So for 2009, your automated goal is just calculating the yearly dividends payment by adding all 4 quarters dividends payments together, you get this number. But apparently, if you are tracing back, to many years, and then this is not the most efficient way to calculating this annual dividends payment. Then we can use another functions. It's called SUMIFs functions in Excel. So we can set up a functions, and then we can just copy the formulas all the way down to 2019. So you just need to solve one value, and you will be able to copy the formulas for all other years' dividends calculation. So we use SUMIFs. The logic from this function is basically the first input will be the sum range. Apparently, we're gonna ask Excel to sum up the dividends payment. So that'll be this column for dividends payment. And we're going to anchor that is because it doesn't matter which year we add. We also always going to ask Excel to sum the dividends payment from this column. And then comma, starting from the first criteria range, basically we want Excel to sum up things from this column by first looking at this column, the first column. And this will be our criteria range 1 and comma. Now we're going to give, I forgot for this part, also anchor that. Again, we want Excel every time look through these columns and see whatever the value match the condition we about to give here, and then they're gonna sum up the dividends payment. So the first condition we're gonna here is we're gonna ask Excel to go through this dates columns, and for this specific row, the 59, we want to find out the dates that is greater or equal to January 1st, 2019, and then less equal to December 31st, 2019. That means after Excel to go through this first column, Excel will only grab the dividends payment from 2019 and add them together to derive this total dividends payment for 2019. So let's use a double quotation, greater or equal to, and use this ampersand signs there. And let's give a date functions. So date functions, you have three inputs, year, month, day. So year gonna be this cell, the A59, whatever the year number you set up for this row, okay? So that will be A59 and comma, January 1st. So 1 there, close the parenthesis. You got this first criteria done. And comma, the second criteria range, same idea. We're gonna ask Excel to look through this first date column again. And we're gonna anchor that. And the condition we're gonna give here is, again, double quotation. That will be less equal to this ampersand sign, date functions. The year, again, that's gonna be A59, but now the month is December, there'll be 12, day will be 31st. Close the parenthesis, close the parenthesis. Again, go through these functions. Basically, what we're doing here, we use the sum ifs function. Apparently, we're adding things up together by giving multiple conditions. That is why this is ifs. So first one, we're gonna sum up the dividends from this dividends column. And then by looking at the dates column, find the date that is greater or equal to January 1st. And then look this dates column one more time, find the dates that's less equal to December 31st for this specific years. Then we hit enter, you get 378. And you can double check. So basically the first 2019, we're adding these four together, you get 378. That means you're right. But if we do this way, then we can basically just copy everything down. You get your annual dividends payment calculated. You can, again, double check for 2009. Let's just sum up the last four that match 168. That means there's nothing wrong with our calculation or function setup. So why we're doing this is because first, we do need to find this dividends over the last year. That is your annual dividends payment, which means there will be this $3.78. Second, we need to estimate what is the growth rate for the dividends. So for this examples here, I did show you there are two ways to estimate the growth rate. You can calculate the annual growth rate and then take an average, or you can calculate the compound annual growth rate. So we're gonna start with the annual dividends growth rate. Here, we're gonna use the long functions, and we use ending year value divided by beginning year value. You get 14.19%. What's this 14.19% mean? That means the dividends, yearly dividends payment for Caterpillar from 18 to 2019, it grew by 14.19%. So this is the annual growth rate. And then we're gonna basically just copy all the formula down. And if you copy that to 2019, you're gonna end up with error is because you do not have 2008 dividends payment. That's why we don't need this one, okay? So this tells you every year how much dividends grow from previous year to this year. Once we have this one, we can use the first method. Let's just taking an average for this growth rate or annual growth rate. We have one calculated. So this is the one growth rate that we can use for this Gordon model, okay? And another way to assess the growth rate, we can calculate in the compound annual growth rate. Compound annual growth rate, that is equal to ending value divided by beginning value, close parenthesis, to the power of, open the parenthesis, 1 divided by number of years. So there will be ending years minus beginning years. So this term inside this parenthesis tells you how many years we're talking about, the number of years. Use 1 divided by number of years. And then close the parenthesis, minus 1. We get a compound annual growth rate calculation. So there's no right and wrong answer, but for our class, at least in the exam, you have to pay attention to the guidance. If I ask you to calculate in the compound annual growth rate, That means if you're calculating average growth rate, you will not get points. Okay. So now we have two growth rate. That means we're going to end up with two estimated cost of equities by using either growth rate. Then we can starting to plug in the value. Remember, for the Gordon model, the information we needed is the share price for now, current price. And then we already got the last year dividends payment. We estimate the two growth rate. And then let's calculate in cost of equity. So share price, let's link this share price all the way to the first tab because I gave you the share price there. So $140.68. Then what is the dividends over last year? That will be our 2019 dividends payment. Now we have two growth rate. Let's just link the growth rate here. First one is for the average growth rate. The other one is for compound annual growth rate. So if we're using this average growth rate, let's calculating what is cost of equity. That is equal to dividends payment multiplied by 1 plus the growth rate divided by share price, and then plus the growth rate. Now you have first one calculating the estimated cost of equity using the average growth rate. Then how about we use the compound annual growth rate? Same idea here. There will be the dividends payment multiplied by 1 plus the compound annual growth rate divided by shares outstanding, not shares outstanding, sorry, the share price. And then plus the compound annual growth rate. And then you get another cost of equity. So this is the Gordon model using two different growth rate to calculating the cost of equity. Now we're going to move to next tab using the capital asset pricing model to estimate the cost of equity because not all the companies, they pay dividends. If they do not pay dividends, you cannot use the Gordon model. So compound annual growth, capital asset pricing model here. Basically, the formula will be this: calculating cost of equity that is equal to risk-free rate plus beta multiplied by the market portfolio return minus the risk-free rate. Or there's another name for the things inside this parenthesis. This is referred as a risk premium. So the extra return you get it by taking the differences between the market return and the risk-free return. Okay. So by looking at this formula, we do need information about the risk-free rate. So risk-free rate sounds familiar is because we already get it from in there under the cost of debt. So this 1.92%, we can use 10-year treasury yield as a proxy for risk-free rate. And then for the rest part, we're gonna need to estimate the beta and then estimate the market return. And then we can plug in this formula to calculating cost of equity for Caterpillar. So let's get started. In order to get the market return, we do need to gather the information, historical information or historical price for the market portfolio. And we also need to find the historical price for the stocks is because we also need to estimate the beta using both market portfolio return and the stocks return to estimate the beta. So in Excel, at least in our class, you watch the LinkedIn Learning, there is a function called stock history in Excel. You can gather the historical stock price easily. But if this stock history function doesn't work on your computer, at least you can also go to Yahoo Finance. Basically just manually collecting the historical financial data. So let's see, I want to gather the Caterpillar stock price or historical stock price. You can search Caterpillar, click this historical data, and then you just have now you have to change that to what you want. You want daily price, weekly, monthly, and then what is the range for the date that you need. So Yahoo Finance, they did make a change this year. Now, if you want to download this data, you have to pay for a subscription. But there is a workaround with that is you don't have to pay for that, but you just have to basically just highlight all this historical information and then you can copy paste to Excel spreadsheet. So then you don't have to pay for anything and you will be able to collect the historical financial information. Okay. But since we learned the stock history functions in class, let's just do everything inside Excel. We don't have to search information outside Excel. We can use the stock history function. And then the first input will be the ticker for the stocks. Caterpillar, that will be CAT. comma, you have to tell Excel what will be the range of data that you want to collect. I want to start it at the 2015 January 1st, comma, and then end it as 2019 December 31st. I only need the monthly data. This is not always necessarily need to be monthly. You can do weekly, you can grab daily. It's really up to you, okay? So for this in-class demonstration, I use the monthly, so I'm gonna type 2 there, comma. Do I need a header? I don't need a header because I already typed the header in this row. That means we don't need header, comma. Oh, actually, for the first one, we can just stop here. Because if you're starting to specify things after, then you're only gonna be able to, Excel only gonna give you the certain data for this thing. But if we stop here, close the parentheses, what we're gonna get is the first column by default, we're gonna get the dates, and the second column by default, we're gonna get the closing price. So we hit enter. Now you see we have the dates. Basically, this falls in the data range we give Excel, and this is the closing price. So this is by default what Excel will give you. And then we need to collect the historical price for SPY, which is the SP 500 index ETF. So we use the same function, stock history. This is the ticker SPY. Start date will be the same, 2015 January 1st, ending 2019 December 31st. And this interval should be match what you get the interval for Caterpillar or the stock data. We gather the monthly closing price. Now we're gonna grab the monthly closing price for SPY as well. And comma, we don't need a header. For this one, we do need to specify the closing price. If you don't specify this one, you're gonna end up with this column gonna give you a dates, next column gonna give you the price. That's what not what we want. We only need the closing price because we already have the dates in the first column, meaning that we're gonna type 1 for this property 1 and the close the parentheses. Then we're given the closing price for SPY or SP 500 ETF, okay? And you should always double check, see if these two columns ended at the same row, because we're gonna conduct like analysis, estimated beta using both informations. It should be the same time interval, should be the same interval of the data, and it should end it at the same dates, okay? Once we're done here, let's calculating what is the monthly return. So we're gonna calculating this return month over month. For the Caterpillar, first one, we're gonna take a long functions here using the February return February price divided by January price, and this will give you the return. Meaning that from 2015 January to February, Caterpillar stocks generate a 3.6% return. For SPY, we do the same thing. We use a natural logarithm here, ending or February price divided by January price. You got a return. And then basically you just do exactly the same thing. We can, technically speaking, we can just like copy all the formula over. So these two columns represents for the return for both Caterpillar and the SPY. Now we're not done, because once we get the monthly return, we do need to find a way to annualize these returns. It's because if you go to your capital asset pricing model method here, this expected market return, it should be annualized return. And when we estimated the beta, we should use it. We can use the monthly return, okay? But for this one, we do need the annualized return. So how to calculate an annualized return? Let's first calculating what is the average monthly return. So we're gonna highlight the entire column for Caterpillar's return. So averagely, the monthly return is a 1.06%. How about SP 500 index ETF? We're gonna do the average functions again. And then 0.81% average return, monthly average return for SPY from 2015 to 2019. Since we're dealing with monthly returns here, when we try to annualize that, we can use the monthly average return. Sorry, 1 plus the monthly average return to the power of 12, and then minus 1. The reason this is to power of 12 is because we try to annualize a monthly return. If this is a daily return, normally we use 252 here. It's because we have 252 trading days every year. If this is a quarterly return, you use 4 here, okay? So then this tells you, like, based on the data we collected from 2015 to 2019, the annualized return for Caterpillar stock is 13.21%. Then how about the market portfolio? Same idea here. We're going to use a 1 plus average monthly return to the power of 12 and minus 1. So the average return for the market is about 10%. Okay, so now if you quickly take a look what we have here, risk-free return, we have it because it's a 10-year treasury yield. Expected market return, we just calculated. That's your annual market return. The only thing left need to be estimated will be the beta. So for the beta, the way to calculating the beta is pretty simple. We can just use slope functions. And then inside the parentheses, you do need to specify what is the y, what is x. In other words, what is your dependent variable, what is independent variable. So our dependent variable will always be the stock interest stock that we're interested. So grab the monthly return for the y, and then comma, grab the monthly return of SPY for the x. Close the parentheses, and you got a beta 1.46. So what's this beta mean? Actually, in class, when I explained the capital asset pricing model, I mentioned that. This means if the market portfolio return increased by 10%, Caterpillar's return should increase by 14.6%. Okay. But what is the idea? Why we use a slope function? So that is why actually I showed you the second method here. Is basically you can visualize this. This is the topic related to statistics you learn from your stats class. This is referred as a linear regression, or more specific, simple linear regression. It's basically in this graph, we try to identify the relationship between the market portfolio return and the individual stock return. So in other words, we want to see how will Caterpillar return move along with the change or whenever the market changed. Okay, so the way to set up this graph is actually what you can do here. Let's just build this graph from scratch. So what you can do, just go to top, click insert. Whenever we try to identify a relationship between two variables, our two variables here, one is Caterpillar return, the other one is SPY return. So if you want to visualize the relationship between two variables, normally we will choose the scatter plot. Okay, so let's just grab a scatter plot. Of course, this is blank because we haven't specified the data yet. So what we can do, let's just right click the chart area, click select data, and now we can starting to fill in the data. So what is the X value? Again, our examples here, the X value should be the market monthly return. So that'll be this column, SPY's return. What is Y here? Y gonna be the individual stock return, because we want to find the relationship between these two returns. Another way to say this is we want to see whether the SPY return can explain the change of Caterpillar's return. Okay, then let's click OK. Now on the chart here, oh, let me select data. Let's add a series here. Okay, so this is more correct. Add a series there. You can give a name, but let's just keep it simple. For the X value, that will be the SPY returns there. For the Y value, that will be the Caterpillar monthly return. And let's click OK. Now on this chart, what we have here, we have all different, the dots here is basically, this is the scatter plot mean, okay? Each dot means like what is the return combinations between SPY return and the Caterpillar return. Now we can add in some elements to this chart. So let's try to make this a little bit cleaner. We can click this grid line here and hit delete on your keyboard. Let's just delete the grid line here. Just keep the y-axis and x-axis. Now let's starting to, maybe we can add the titles there. What is the title for this chart? We try to visualize what is the Caterpillar return versus SPY return. And then practically I gave you the colors there. So basically you can just Let's double click the chart area. If you want to give a color, you can give a color. So let's just pick a colors there. Okay, this is more for aesthetics. Okay, now let's starting to add a title to the x-axis and the y-axis. So click the chart. On the top, there's a chart design, and then we can add chart elements here. So let's add the axis title for primary horizontal. So this is where they put the horizontal titles here. Let's move down a little bit. That means like what is the data represents the x-axis. So this is SPY return. And then let's add another chart elements there. There will be axis title for primary vertical. So for the y-axis, what's the y-axis represents for? Y-axis represents for the caterpillar return. Okay. So by looking at this chart, I know sometimes you may feel like this is hard, but at least looking at these scattered points here, it looks like, roughly speaking, SPY return and the caterpillar return have a positive linear relationship here, meaning that you can take a look, generally speaking, when SPY return going up, and we see the caterpillar return also going up. Okay, if you find this relationship is hard to identify, technically speaking, I also agree with you, is because we can check the R-square there. So if you find this is hard to identify, what we need to do is we can, technically speaking, we can just, again, go to this chart design, add a chart element. Let's add a trend line there and for this linear relationship. After you add a line, apparently this line will tell you much better relationship between the SPY return and the caterpillar return. So it seems like they have a positive linear regression relationship. Again, when the SPY return going up, you do see caterpillar return also going up. Okay, but what exactly is the function of this straight line here? So this is where we can double click this straight line, and then we can check this display equation and also display R-square. So if you check this display equation, now you're gonna find out, okay, we have a 1.4696, 1.4696. That's exactly match what we just estimated for the beta. So that is why we use a slope function. It's because this 1.496, 1.4696, it is the slope for this straight line. Okay, so meaning that basically this is the relationship between the SP500 return and the caterpillar return. But if you look at R-square, apparently, yeah, the reason maybe some of you guys arguing that this is hard to identify, which I agree with you, is because R-square tells you basically, yeah, the SP500 return can only explain 44.56 return, 44.56 of the caterpillar's return. So it only explained the 44.56 changes for caterpillar's returns change, meaning that there are other factors that you should count it in to explain the why caterpillar return change in a certain way. Okay, but we don't worry about too much about R-square here. Our focus here is we do want to find what is the beta here. So I want to show you this visualization, just want to explain where this slope idea come from. Is because this beta is the slope for this linear regression, which identify the relationship between SPY return and the caterpillar return. Okay, so that's why I put the method 2 here. You can use this visualization, find the trend line, find the relationship here, and then you can basically just hard code it from the trend line. We know that this beta should be 1.4696. But apparently for the hard-coded one, it will be slightly different from the one you use the slope function, is because if you give more decimals here, you see this is not exactly 1.4696. But again, the idea are the same. Why this is a slope is because that is the slope for the linear regression between the SPY return and the caterpillar return. Now we have the beta. We have the expected market return, and then we just need to grab that 10-year treasury yield. We will be able to solve this cost of equity using the capital asset pricing model. So the beta, we're gonna just link to this slope function, derive the beta, risk-free rate. Let's go to this 10-year treasury yield one more time. We're going to find the December 31st for 2019. Again, why this one is because we're analyzing these Caterpillars at the end of 2019. So 1.92% expected market return. That is the annualized SPY return we calculated here. Then the cost of equity just equal to risk-free rate. Follow the formulas here. Plus beta multiplied by the differences between market return and the risk-free return. Now you have your cost of equity calculated using the capital asset pricing model. Then we move on to the next method. We can estimate the cost of equity, which is the comparable firms method. So some companies, you may not have the information that you can estimate the beta, or specifically if you have a public company, you try to analyze, you don't have their stock price because they are not traded publicly. Then how are you going to be able to assess what is the cost of equity? So that's where this method come into play, okay? So the idea of this one is we're going to find the close competitors who are public traded. So that means you do have their information about their equity value, debt value, but more importantly, you will have information or you can estimate their beta for their business. So what we're going to do here, because these are our close competitors, we're going to use their beta, try to make a little bit adjustment, and to use that as a proxy for our beta in our cost of equity calculation. Okay, so apparently there are some adjustments that you have to make. The reason you have to make adjustment is because for these four competitor examples here, we do see certain companies, they do using debt. So this is more going to require a little bit better understanding about this external funding. So I mentioned in class, companies will raise the fund externally either through debt or through equity. So if you borrow the money through debt, technically speaking, you put your companies into higher risk, is because if you're using debt, you have to pay interest. It doesn't matter you make money or not, you still have to pay interest and pay back the debts. So if you are facing a finance constraint, or meaning that during the COVID period, you don't make money, so because you borrow the money through debt, you have to pay interest, it may put you on a very dangerous spot. Maybe you're going to face a bankruptcy because you may not have money to pay off the interest that you promised to your debt holders. So this will give you the idea. Different companies, they're using different level of debt, meaning their companies are facing different level of risk. So when we try to estimate the beta using our competitors' information, first step we need to do is we need to recalculating the beta by taking out the impact or the actual risk that the companies added to their companies when they using the debt. Meaning that different company, they use different debt, meaning they impose different risk to their company's shareholders. Therefore, their beta going to be different. The higher the risk, the higher the beta. But when we try to solve our company's beta, we should not including other companies' risk from their debt using. We do need to consider the risk that our company's debt using that they impose to our shareholders, but we don't have to worry about the risk coming from other companies' debt. Therefore, we first are going to calculating what is the unlevered beta, meaning that let's get rid of this debt impact or the actual risk that the debt imposed to the company. So we're gonna calculating what if the company doesn't use debt, what will be the beta? And then we use that unlevered beta as a proxy for our company. And if our company using that, we're gonna put back the risk to the betas only related to the debt that our companies are using, okay? So that's basically the ideas here. So that is why we are getting the beta from our competitors' companies. And this beta also referred as the levered beta, is because some of our competitors, they use debt. And the beta risk or the incremental beta risk is part of that is coming from the debt. So first step, we're going to unlever the beta, taking out the risk that coming from individual companies' debt. And then we're going to use this unlevered beta as a proxy for our company. And if you find out for Caterpillar specifically, we do know that the Caterpillar using debt, meaning that now we have to re-lever the beta. gave this unlevered beta the actual risk that's specifically linked to our company's debt. Now we can calculate in the beta, and we can use capital asset pricing model again to assess what is the cost of equity. Okay, so since we eventually still gonna using the capital asset pricing model, then we're gonna need to grab the information. Risk-free rate, we can go back to the CAPM model, grab your risk-free rate. Expected market return, we can go back to the CAPM model, grab the expected market return. Okay, now we just need to calculating what is the unlevered beta for our competitors, taking an average to derive the industry unlevered beta, and then we're gonna re-lever the beta using our company's or Caterpillar's data information. And then we plug into the capital asset pricing model to calculating cost of equity. So first, how to calculating unlevered beta. I already gave you the formulas here. It sounds a little bit complicated, but when you plug in there, it's really not that complicated. So basically, each company, if you are having a levered beta and you're trying to solve this unlevered beta, just using your levered beta, so that's your numerator here, divided by open the parentheses, there'll be 1 plus open the parentheses 1 minus that company's tax rate, so 1 minus your competitor's tax rate, close the parentheses, multiply by the net debt value and divided by the equity value. Close the parentheses. You got unlevered beta. Apparently for the first comment, you're gonna ask like, wow, these two look exactly the same, because it's supposed to be the same. The reason of that is because the first company doesn't use that. So there's no actual risk you put into the company by using that. But if you do copy this formula down to our other competitors, you're gonna realize, okay, so if we unlever this beta, meaning that if we assume the company doesn't using that, then you're gonna realize this beta risk becomes smaller, which makes sense. It's because you don't use that, you reduce the risk that your companies are facing. When you're operating your business during the COVID period, you don't really need to worry about paying somebody's interest or paying the debts back, is because you don't use that. So that's what we found here for all three other competitors. Once you calculate unlevered beta, once you take out the risk from your debt holdings there, you're gonna end up with a lower beta risk. Okay, so then what we need to do, let's just taking an average for these 4 unlevered beta. This will be a good proxies for your companies. Is because basically we don't consider the debt interest debt from specific companies by taking average for our competitors unlevered beta. So we can assume, average speaking, if you operate in the same industries, and this will be the unlevered beta that you can use. But we can not use this one directly. The reason of that is because Caterpillar do use that. So that means we do need to re-lever this beta, okay? So then let's just get started here. How are we gonna be able to re-lever the beta? This will be the formula you're gonna use. So you're gonna use this unlevered beta, which is this average industry unlevered beta. Use that to multiply by 1 plus 1 minus Caterpillar tax rate, and multiply by the net debt value divided by equity value for Caterpillar. So now let's starting to link net debt is coming from your debt schedule or debt values. This will be the net debt. And the equity value, this is equal to equity value from your first tab. Corporate tax, this is coming from your corporate tax tab. Now we can calculating this levered beta for Caterpillar using this formula. This is equal to this unlevered industry average beta multiplied by 1 plus 1 minus the tax rate, and then multiplied by the net debt value divided by the equity value, close the parentheses, you get your levered beta. And apparently this number 1.55 is higher than 1.22, which is right. It's because Caterpillar using that. So basically you are adding more risk to our shareholders. So in other words, you're increasing the beta risk. So that is why we have this levered beta is higher than the unlevered beta. Now you have everything you needed. Risk-free rate is coming from here. Market Oh, here I put the market risk premium. You can change that. Basically, what is market risk premium? That is the market return minus the risk-free rate. So if you find this term is confusing, you can just change it to market return. The market return will be 10.18%. What is cost of equity? This is equal to, you go back to use this formula, risk-free rate plus beta multiplied by this term is the market risk premium. Differences between market return and risk-free return. So this is equal to risk-free rate plus the beta, which is the levered beta we calculated here, multiplied by the market return minus the risk-free return. And you get your cost of equity using the comparable firm. Okay. And then we now have everything solved, and there's no other method I'm gonna introduce here. So meaning that we're gonna jump into the last step, which is the weighted average cost of capital calculations here. For the weighted average cost of capital calculations, we just have to plug in things to this formulas here. And apparently we estimated the cost of equity using 3 different methods. So that means we're gonna end up with 3 WACC here. And eventually we can take in an average, or you can pick either one you think is more reasonable. Okay. So for the last tab here, the starting to link values. Equity value, this is linking from your equity value tab here. And then for the net debt, we're gonna link the net debt here. So this is the part, like you don't have to always using net debt. If you believe the company funded their operations using the debt, you should using total debt. You should use your total debt value. And that means for a cost of debt, you should use this, just the expenses, interest expense divided by debt value. But if you decided like this one, if I decided using net debt, and then for this cost of debt, we're gonna link to this cost of debt is because we're using the net debt. So the cost of debt, it should be the net interest paid divided by net debt. So this has to be consistent. Okay. If you're using total debt value, then this will equal to this 1.13%. Okay, now we are linking that, and then the tax rate will be 22.35%. Now you can calculating WACC, you use this way, but it will be more easier. That's just starting to calculating things or try to consolidate this calculation. Basically this term, D divided by E plus D, this just calculating the weights of debt, and this calculating the weights of equity. So another way to see this formula, that will be the weight of debt and then multiply by cost of debt and then multiply by 1 minus tax rate and plus the weight of equity multiplied by the cost of equity. So this will give you the weights of debt. This will give you the weights of equity. Then we can calculating that, then your WACC setup will be simpler. So what is the weight of equity? That is equal to this E divided by E plus D. So that will be the equity value divided by the sum of equity value and debt value. This will give you the weights. So apparently for Caterpillar, 74.32% money is coming from equity. Then how about debt? That is equal to this debt divided by sum of these two. You get the weights for the debt. Another way to solve this is basically if 74 goes to the equity, then you use 1 minus this will give you the weights for the debt. Okay, it really depends on how you calculate it. Then let's consolidate this part. Let's just directly calculating what is after tax cost of debt. That is equal to cost of debt multiplied by 1 minus tax rate, and you get your after tax cost of debt. Okay, now basically we simplify this even further. This will be the weights of the debt multiplied by after tax, cost of debt and plus the weight of the equity multiplied by cost of equity. We already have the weights. We have the after-tax cost of debt. What we need, we're just starting to link cost of equity. For Gordon model, let's link from Gordon model. Let's just link the this one, the compound annual growth rate derived the Gordon model one. Okay, feel free to link both. That means you're gonna have 4 WACC calculated here. So to keep it shorter here, I'm gonna only link that one from Gordon model, and then for the capital asset pricing model, I'm gonna link this 14.06. For the comparable firm that method, we're gonna link this at 14.73%. Now you have a 3 cost of equity plug in here. You have weights calculating. You have the after-tax debt calculated. Now we can just calculating WACC. WACC is equal to, so the weights, or let's just follow this order here. We're going to use the weights of the debt multiplied by this after-tax cost of debt and the plus the weights for the equity and multiplied by the cost of equity. Okay. And apparently, if you click this one, these 3 terms, it's going to remain the same for, doesn't matter how you change your cost of equity. So if we anchor these 3 terms, then what we can do here, we can basically just copy and just paste the formulas there. You will get your WACC calculated. Oh, I didn't anchor that right. Okay, so now let's just copy and paste the formula there. Now we have the WACC calculated. But basically what you do here, you do exactly the same calculation. For this one, we're gonna use the weights of debt multiplied by this after-tax cost of debt and plus the weights for the equity multiplied by this cost of equity. Here, same idea. This, I'm gonna just redo this one more time. This is equal to the weights of the debt multiplied by after-tax cost of debt and the plus the weights for the equity multiplied by the equity. And you got the WACC for this specific estimated cost of equity. Then, yeah, what you can do is you can take an average of all 3 to get the average cost of weighted average of the WACC. So comma, you grab 3, taking an average here. So the average cost of WACC will be this, average WACC will be this 10.06%. You don't have to always do an average here. You can pick, like either one, or if you believe this is relatively speaking, this is like way lower than the other 2, you can take an average between these 2. It's really up to your assumptions. So for a Tesla project, I don't really worry about like which method you use and whether you did average or not. As long as you have a WACC, you plug into your DCF model, that is good. Okay. So this will complete this video. Basically, in this video, we walk through every component's calculations using various methods to estimate the cost of debt, cost of equity to derive the WACC. Okay. Let me know if you have any questions. So this is it. Bye.